Good day, fellow investors! We continue with our analysis of the top 25 stocks of the S&P 500, and Amazon is of course one of them. It's a great business and you learn a lot always by looking at Amazon. I put this all in my valuation. You can download this table in the link in the description below. It's free. You have also the valuation table, and then you can play around and see also whether you agree with these inputs that I have put, whether you have better inputs, and what is your intrinsic value depending on your discount rate or required return. If you like these analyses, plenty more of stock analysis here with the value investing perspective always, so if you like that, smash that like button to support the channel. It means a lot. So let's start with Amazon, stock price overview, conference call, notes, evaluation, and the risk-reward thesis. So of course, if you look at the long-term chart of Amazon, it has been really staggering, and I must say I didn't understand the investment here, and here I was just an old-fashioned value investor looking at price-earnings ratios, and that is wrong, that was wrong, and is still wrong to look at from a valuation perspective of Amazon. Of course, over the last year, the first year that Amazon didn't go up, but that's usually normal with these growth stocks, and then you have to see, okay, what's coming next, and that's what we will discuss. At the conference call, they have showed that they are investing insanely back into the business, all the money, and they don't even have cash flow positivity anymore on the basis of how much investments they make. Of course, the long-term goal is to optimize those free cash flows, so at some point in time, someday, when they don't have growth opportunities, then they will work on optimization of cash flows. For now, net sales have gone up even higher than the great 2020 year, so 9% year over year. For the quarter, of course, total year up 22%, which are staggering growth rates for already something that is a big business like Amazon. Operating income also 9% higher. Why we're using operating income? Because if you look at net income, it is skewed by pre-tax valuation gain of Rivian of 11 billion, so it's better to focus on operating income with Amazon and then look at what they are doing with that money. And you can see here, this is TTM trailing 12 months, they have almost doubled their investments into property and equipment, which is really insane. But there is so much demand for their products that they need to do that to just cater to the business. And that's also the key. And if we switch to the conference call, there is so much to invest and to build on with Amazon that this is insane. Amazon Web Services grew 40% in Q4, which is really insane, and they announced more than 150 new services at the last event. Then, discussing business power and pricing, they are increasing the price of Prime in the United States. They are pushing it up from yearly membership from $119 to $139, which is a significant increase, but likely they have the power to do it. And then, of course, if we look at Q&A, the key is, okay, how long will you keep investing and when we will see more cash flows like for a normal valuation, because analysts need those cash flows to make a valuation. And the answer is, to wrap it up, it will increase year over year, so they will not stop spending, they will not stop building, but the goal is one day to reach profits, one day down the road. So if profits are irrelevant for the company, how to value this? Well, revenue is the focus, growth is the focus, so we must think, okay, what will be the potential that Amazon could earn if it wouldn't reinvest into everything. If we look at Morningstar, what is their projection? They expect the core business to grow at 12%, the retail business, Amazon Web Services to grow at 23%, and advertising to grow at 20% per year over the next 5 years, so an average of 14% per year through 2026, and then we also see operating margins expanding 5% to 8% in 2026. So let's go to cash flow potential. Let's say that one day they reach 10% free cash flow potential, so less investments, working on scale there, and that 10% of everything can be free cash flow for buybacks or something like that. Okay, this is a little bit stretched, but they have been increasing their operating margin over time, so 5 to 10%. Let's take 10% and see where the valuation leads us. Current revenue is 469 billion. 10% of that would be 46 billion. Let's take a 20 valuation on the potential free cash flow one day and then put it into our comparative table. So 46 billion we said, and if they keep growing at 5%, of course the intrinsic value is 1.9 billion and slowing down to 15%. Perhaps 25% is a little bit too high. Even Morningstar said 16% given the scale that they already reached, and let's say 12% down the road with a terminal multiple for a 10% return, then the intrinsic valuation is already much lower. But given the scale, given the business, that's the risk and reward of investing. Of course, if they grow at faster rates, then we are at 2.3 billion and it's still cheap. But if things slow down and they grow just 15%, then slow down to 10%, and the market gives a lower multiple to that, then the valuation and the risk is there significantly, because you can lose, let's say, 50% of your investment. And okay, the reward for Amazon is that they keep growing, like it has been the case over the last 20 years, which that they did remarkably. But there is also one risk, and the more time passes, this risk gets bigger and bigger, and that's the size risk. If we go back to our table, now, okay, let's say they could do 46 billion in cash flows if they would want to do that, and they focus on growth, and then the question is, okay, will they be able to do these cash flows down the road for these growth rates? Okay, 16%, 12% growth, they should get to $170 billion of free cash flows in 10 years. So that's 4 times the current size. Can Amazon grow 4 times the current size is the key risk and key question. And if they stop growing, if growth slows down, then this is the worst case scenario, and then things start to get a little bit tricky. So whenever you look at Amazon, what they did in the past, it's a miracle. It's an amazing thing. But the risk and reward simply is always there. So you need to have big guts to buy something like this. And then we have seen with Facebook what happened there. What happens when the growth stalls or is below expectations? How fast can things change? And I wouldn't wish to anyone to see that, especially if Amazon is a larger position. But yes, they are still investing into the ecosystem. They are just building, and that should create value, has created value in the past, so that should go forward. For me personally, there is simply too much of that growth risk. What if it doesn't happen? And I know I have been thinking the same in 2011, in 2013. Of course, I was wrong back then. I didn't see it, but I'm thinking at some point this growth should be slower ahead, and maybe it will not. Maybe yes, maybe not. But for me, this is a too complex answer to look. And as a value investor, I prefer investment thesis where the risk is low and the reward is higher. The reward with Amazon is definitely there, pretty high, double-digit returns if they just keep on growing, but the risk is also certainly double-digit if things change. So in my valuation table, I have a ratio that is not enough for a 10% return over the long term, but still good, should do 5, 6, 7 returns there. If there is growth, even better, but really reaching 300 billion in cash flows down the road for, let's say, what is this? If I change the discount rate, then let's say it is valued now in the best case scenario for a 15% discount. So that would be the difference there, and 10 to 15% for the risk. The risk and reward simply doesn't suit me. We'll continue with the analysis. Thanks for watching, check the other videos, and I'll see you in the next video.